In this lecture we discuss cost volume profit analysis, which is also referred to as CVP analysis. Understanding the relationship between a firm's costs, profits and volume levels is very important for strategic planning. When you are considering undertaking a new project, you will probably ask yourself, how many units do I have to produce and sell in order to break even? The feasibility of obtaining the level of production and sales indicated by that answer is very important in deciding whether or not to move forward on the project in question. Similarly, before undertaking a new project, you have to assure yourself that you can generate sufficient profits in order to meet the profit targets set by your firm. Thus, you might ask yourself, how many units do I have to sell in order to produce a given target income? You could also ask, if I increase my sales volume by 50%, what will be the impact on my profits? CVP analysis helps you to answer these types of questions. We will now derive a formula that helps us to calculate the activity level at which a firm is just covering its expenses but not yet generating any profits. This activity level is known as the firm's break-even point. In order to derive our formula, we will assume that the following variables have the meanings given on the screen. P stands for the selling price per unit. X stands for the units produced and sold. V stands for the variable cost per unit. F stands for the firm's total fixed costs. OP stands for the firm's operating profits. Operating profits are a company's before tax profits. T stands for the firm's tax rate. Your sales revenue is equal to the number of units sold times the price you get for each unit that you sell. In other words, sales revenue equals PX. Assume that you have a linear cost function, and your total costs equal the sum of your variable costs and fixed cost. So, total costs equals VX plus F. When you break even, your sales revenue minus your total costs is equal to 0. If you move your total costs to the other side of the equation, you see that your sales revenue equals your total costs when you break even. Now, we want to solve for the number of units produced and sold that satisfies this relationship. Remember, when our firm breaks even, its revenue equals its total costs, which can be read as PX equals VX plus F. If you move VX to the left-hand side of the equation, then PX minus VX equals F. If you factor out the common X on the left-hand side, you get X times P minus V equals F. If you move the P minus V to the right-hand side, you get X equals F divided by P minus V, which we will call formula A. P minus V is also called the contribution margin per unit. So, sometimes formula A is written as X equals F divided by the contribution margin per unit or CMU. Now, let us do an example. Assume that a firm sells its product for $200 a unit. Assume further that its variable cost per unit is $120, and that its fixed costs are $2,000. We will now plug those values into our formula A, which is X equals F divided by P minus V. This gives us X equals $2,000 divided by $200 minus $120. This equation becomes X equals $2,000 divided by $80, which gives you the break-even point in units. We now know that our firm will break even when it sells 25 units. Although we used formula A to derive the break-even point, we could have easily come up with that activity level without the formula, once we realized the information that the contribution margin per unit gives us. This information consists of the fact that our firm makes $80 every time it sells one unit. Once you realize this fact, then the answer falls into place. Ask yourself, given that my firm makes $80 every time that it sells one unit, how many units does it have to sell in order to make $2,000? To get the answer to that question, you would divide $2,000 by $80, which is Formula A. Formula A gave you the number of units that your firm needs to produce and sell in order to break even. If you multiply both sides of Formula A by P, you get Px equals Fp divided by P minus V. This can be simplified to Px equals F divided by P minus V divided by P, which we will call Formula B. Formula B gives you the amount of sales revenue that you need to sell in order to break even. Formula B's denominator, P minus V divided by P, is also called the contribution margin ratio. So, sometimes Formula B is written as Px equals F divided by the contribution margin ratio. Let's use Formula B on our previous example. If we substitute the given price of $200, variable cost per unit of $120 and fixed costs of $2,000, we get a break-even point in gross sales dollars of $5,000. Using Formula A, we knew that we needed to produce and sell 25 units in order to break even in our example, and we knew that one unit sold for $200. If we multiplied the 25-unit break-even point by the $200 price, we could have derived the $5,000 break-even point without using Formula B. So, why do we need to use Formula B? The reason why we derived Formula B is that there are situations where you cannot use Formula A, but you can still use Formula B. Consider the following example. Assume that a company has gross sales revenue of $100,000 and total variable costs of $30,000. If you subtract the total variable costs from the gross sales, you get the contribution margin for all of the units sold, as opposed to the contribution margin for one unit. Also assume that a company has fixed costs of $50,000 and operating profits of $20,000. Can you use Formula A in this example? We don't know the number of units sold. So, we cannot convert the gross numbers into per unit numbers. If we don't know the price of one unit, and we don't know the variable cost for one unit, then we cannot use Formula A. All we know is the total fixed costs of $50,000. Although we do not know the individual unit's price and variable cost, we can still derive the contribution margin ratio as follows. You first subtract the total variable costs from the total sales. This gives you the contribution margin for the firm. You then divide the contribution margin by the total sales. As you can see, you can simplify your numerator of Px minus Vx into x times P minus V. Now that you have x in both the numerator and the denominator, you can cancel the x, which leaves you with the contribution margin per unit. The contribution margin ratio is 70% in our example, and when you divide the fixed costs of $50,000 by 70%, you get the break-even point in sales dollars of $71,428.57. We now want to calculate how many units we have to produce and sell in order to generate a given before-tax profit. We will do this by modifying our formulas A and B. Let's start with the fact that our revenue minus our total costs gives us our operating profits. Now, add the variables that we used previously to turn this relationship into an equation. This gives us Px minus Vx minus F is equal to OP. Now, move the F to the other side of the equation. Next, factor out the common x from the Px and the Vx so that the equation reads x times P minus V equals F plus OP. When you move the P minus V to the right-hand side of the equation, you have a modified formula A, which is X equals F plus OP divided by P minus V. As you can see, the modified formula A is the same as the original formula A, except that OP has been added to the numerator on the right-hand side of the formula. Please remember that P minus V is the contribution margin per unit, and that the modified formula A can be written as X equals F plus OP divided by the contribution margin per unit. As we did before, we can multiply both sides of the modified formula A by P to get a modified formula B, which reads Px equals F plus OP divided by P minus V divided by P. Please remember that the denominator, which is P minus V divided by P, is referred to as the contribution margin ratio, and that the modified formula B also can be written as Px equals F plus OP divided by the contribution margin ratio. Let us continue with the same example that we used before and add the fact that our firm wants to generate $40,000 of before-tax profits. Using the modified formula A, we get X equals fixed costs of $2,000 plus operating profits of $40,000 divided by the price of $200 minus the variable cost of $120. Modified formula A tells you that you have to sell 525 units in order to cover your fixed costs of $2,000 and generate operating profits of $40,000. Please remember that operating profits are before tax profits, and that if you subtract your tax expense from your operating profits, you end up with your firm's net income. What if a problem asked you to figure out how many units your firm must sell in order to generate a specified net income figure? In that case, you should calculate the operating profits that would result in the specified net income after you have paid your firm's tax expense. Once you have that figure, then use the operating profits figure in the formulas as we have done previously. Please remember that the modified formulas require you to use operating profits, and you can't use net income in those formulas. Let us do an example. Assume that the problem asks you to determine the number of units that you must sell in order to generate a net income of $50,000. In addition, assume that your tax rate is 40%. The first thing that you must do is calculate the operating profits that your firm would have to generate in order to end up with a net income of $50,000. We know that our operating profits minus our tax expense is equal to our net income. We also know that our tax expense is equal to 40% of our operating profits. This leaves us with the following relationship. OP minus 40% of OP equals our net income of $50,000. OP minus 0.4 times OP can be simplified to 0.6 times OP. So, now we know 0.6 times OP is equal to our net income of $50,000. If we move the 0.6 to the right-hand side of the equation, this tells us that OP is equal to $50,000 divided by 0.6, which is $83,334. You can easily check to see if you have the right operating profits figure. Take your operating profits and subtract your tax expense, which is your operating profits multiplied by your tax rate. The result should be your required net income figure. Now consider what you should do if you are asked to calculate the amount of sales you will need in order to generate an operating profits figure that is equal to a given percentage of your gross sales. We shall use our previous example, and add the requirement that we must generate operating profits equal to 10% of our gross sales. Start with modified formula B, so that you have Px equals 2000 plus 10% of Px divided by 200 minus 120 divided by 200. This results in Px equals 2000 plus 10% of Px divided by 40%. If you move the 40% to the other side of the equation, you get 0.4 Px equals 2000 plus 0.1 Px. If you move the 0.1 Px to the left-hand side of the equation, you get 0.3 px equals 2000. If you move the 0.3 to the right-hand side of the equation, you get px equals 2000 divided by 0.3, which tells you that you need sales of $6,667 in order to generate a profit equal to 10% of your gross sales, which is $667. We will now discuss how you would conduct a CVP analysis when your firm has more than one product. Basically, you would use the same formulas that we have discussed previously. However, when the formula calls for price, variable cost, contribution margin, or contribution margin ratio, you must use variables that represent the entire range of products that your firm carries. For example, assume that you need to use formula B for a firm that has two products. In that case, you need to use a contribution margin ratio that reflects both of your products. The easiest way to do this is to calculate the contribution margin ratio for the company as a whole. Remember that if you take a firm's total revenues, which are Px, and subtract its total variable costs, which are Vx, and then divide by Px, you get the firm's contribution margin ratio. When the revenue and variable costs reflect the firm's total product range, then the contribution margin ratio also reflects all of the firm's products. So, you can get a contribution margin ratio that reflects all of a firm's products by dividing its contribution margin by its sales revenue. We did this earlier. If you will recall, when we were discussing the need for Formula B, we offered this example, and we said that you couldn't use Formula A because you didn't know the contribution margin per unit, but that you still could use Formula B because you knew that the contribution margin ratio was 70%. If these figures represent more than one product, then you know the contribution margin ratio for the firm's full range of products is 70%. If you want to use Formula A, then you need the contribution margin per unit that reflects all of your firm's products. We can calculate this by using one of two approaches. You can either use the basket method or you can use the weighted average method. Let us do an example. Assume that a company sells two products, gourmet bananas and oranges. Assume that the firm sells 3 bananas for every orange that it sells. In other words, 75% of the units that it sells are bananas and 25% of those units are oranges. Moreover, assume that each banana sells for $2 and that its variable cost per unit is $1, giving you a contribution margin per unit of $1. In addition, assume that each orange sells for $4 and that its variable cost per unit is $2, giving you a contribution margin per unit of $2. Also assume that the firm's fixed costs are $2,000. We will first calculate the break-even point for our firm using the basket method. With this method, you must construct a basket that reflects your firm's product mix of 75% bananas and 25% oranges. We will use a basket containing 3 bananas and 1 orange. Keep in mind that you may use any basket that you wish so long as its contents are 75% bananas and 25% oranges. For example, you could have used a basket containing 6 bananas and 2 oranges. Next, you need to calculate the contribution margin for your basket. Our basket contains 3 bananas with a contribution margin for each banana of $1. It also contains 1 orange with a contribution margin per orange of $2. So, the contribution margin of our basket is 3 bananas times $1 plus 1 orange times $2, which gives you a contribution margin for the entire basket of $5. Now that you have the contribution margin for your basket, plug that figure into Formula A. With Formula A, you know that the number of baskets that your firm needs to produce and sell in order to break even is equal to your fixed costs of $2,000 divided by the contribution margin per basket of $5, which gives you 400 baskets. 400 baskets contain 3 bananas each, for a total of 1200 bananas. Each of those baskets also contains 1 orange, for a total of 400 oranges. Thus, you must produce and sell 1200 bananas and 400 oranges in order to break even. We will now solve this problem using the weighted average method. With this approach, you need to calculate the average contribution margin per unit for your entire product line. In calculating this average, we will weight each product by the number of units sold. So, our weighted average contribution margin per unit is equal to 75% times the contribution margin of a banana, plus 25% times the contribution margin of an orange. This results in a weighted average contribution margin per unit of fruit that is equal to $1.25. Next, we plug our weighted average contribution margin per unit into formula A. Using that formula, we divide fixed costs of $2,000 by the weighted average contribution margin per unit of $1.25, which results in 1,600 units. So, we know that we must produce and sell 1,600 pieces of fruit in order to break even. If you must produce and sell 1,600 pieces of fruit in order to break even, and 75% of those units are bananas, then your firm must produce and sell 1,200 bananas. Similarly, 25% of those units are oranges, which means that you also must produce and sell 400 oranges in order to break even. We will next discuss margin of safety. The margin of safety describes the amount by which a company's current operations exceeds its break-even point. The margin can be described using either dollars or units. Assume that a firm currently sells 40 units for $8,000. Also assume that it breaks even when it has sales of 25 units for $5,000. That company's margin of safety can be described as either 15 units or $3,000. We will now discuss operating leverage. Suppose you are considering taking an action that will increase your contribution margin by a given percentage, and you want to know how much your operating profits will increase after taking that action. Operating leverage is a tool that allows you to answer that question quickly. Consider the following example. Assume that a firm having the operations shown on the screen is considering taking an action that will increase the number of units that it sells from 40 to 60, and you want to know how much that firm's operating profits will increase as a result of that action. You could get that information by recalculating the firm's revenues and variable costs as is shown in the next slide. As you can see, when the firm sells 50% more units, its revenue and variable costs also increase by the same percentage, and its operating profits increase to $2,800. Another way to get the increase in the firm's operating profits is to use operating leverage. Operating leverage is the number that you get by dividing a firm's contribution margin by its operating profits. When you multiply the firm's operating leverage by the percentage increase in its contribution margin, you will get the percentage increase in that firm's operating profits. In our example, the firm's contribution margin was originally $3,200 and its operating profits were originally $1,200. When you divide these two numbers, you get an operating leverage of 2.67. When you multiply the firm's operating leverage of 2.67 by the 50% increase in its contribution margin, we are told that the firm's operating profits will increase by 133%. When you multiply the 133% increase by the firm's original operating profits of $1,200, we discover that the firm's operating profits will increase by $1,600, resulting in a new operating profits figure of $2,800. As was mentioned earlier, if you want to use Formula B, you need to use a contribution margin ratio that reflects all of the firm's products. As noted above, the easiest way to do this is to divide the firm's total contribution margin by the firm's total sales revenue. Instead of doing this, some students try to calculate a weighted average contribution margin ratio. The next slides show you how you can do this. Consider the following example where a firm sells gourmet apples and pears. In a given period, it sells 60 apples and 40 pears. The price of each apple is $2, and its variable cost is $1, resulting in a contribution margin ratio of 1/2 or 50%. The price of each pear is $4, and its variable cost is $3, resulting in a contribution margin ratio of 1/4 or 25%. The firm's fixed costs are $2,000. We want to calculate the sales revenue that will allow this firm to break even. The firm sells 60 apples at $2 each and 40 pears at $4 each, giving the firm a total revenue of $280. The firm's variable costs consist of 60 apples times their variable cost per unit of $1, plus 40 pears times their variable cost per unit of $3, for a total of $180. Using these figures and the given fixed costs of $2,000, we can calculate the firm's contribution margin and operating profits. We can also calculate the firm's contribution margin ratio of 35.71%. You could also construct the weighted average contribution margin ratio in a manner similar to that used with the basket method, but what you have to remember is that the weights that you will be using are based on sales dollars, not units. An easy way to remember this is to recall that Formula A calculates the units that you need to break even, and it uses weights based on units. Similarly, Formula B calculates the sales dollars that you need to break even, and it uses weights based on sales dollars. In order to construct our weights, we must first calculate the revenue that our firm gets from each product. We sell 60 apples at a price of $2, giving us revenue from apples equal to $120. Similarly, we sell 40 pears at a price of $4, giving our firm revenue from pears equal to $160. The firm's total revenue from these two products is $280. When you divide our revenue from apple sales of $120 by the firm's total revenue of $280, you see that 42.86% of the firm's revenue comes from apples. Moreover, if you divide the firm's revenue from pear sales of $160 by our total revenue of $280, you see that 57.14% of our revenue comes from pear sales. We will use these percentages to construct our weighted average contribution margin ratio. Please note that these percentages are substantially different than the weights based on units sales. Despite the fact that 60% of the units that we sell are apples, only 42.86% of our revenue comes from apples. Similarly, although pears only account for 40% of the units that our firm sells, it generates 57.14% of our revenue. Our weighted average contribution margin ratio is equal to 42.86% times the contribution margin ratio of our apples, which is 50%, plus 57.14% times the contribution margin ratio of our pears, which is 25%. This gives us a weighted average contribution margin ratio of 35.715%. Please note that this is the same contribution margin ratio that we got earlier by dividing our contribution margin by our sales revenue. Using Formula B, we can divide our fixed costs of $2,000 by our weighted average contribution margin ratio of 35.715% to determine that our firm will break even if it can generate a sales revenue of $5,600. If our firm has sales revenue of $5,600, and 42.86% of our sales revenue comes from apples, then we know that our apple sales must equal $2,400 in order for our firm to break even. In addition, since 57.14% of our sales revenue comes from pears, we know that our pear sales must equal $3,200 in order for our firm to break even. When you divide those figures by the individual price of an apple and pear, you see that our firm must sell 1,200 apples and 800 pears in order for it to break even. We can construct an income statement for our firm using the prices, variable costs and fixed cost given previously. As you can see, the income statement confirms that our company will break even if it sells 1,200 apples and 800 pears. The end.